Today, let us prepare ourselves to understand the meaning of government budget, the components of government budget, and its importance or objectives of government budget. The origin of the word budget is traceable to the French word budgets, which means a small bag. For the first time in 1733, the British Finance Minister Sir Robert Walpole presented the budget in British Parliament. In India during British period, James Wilson presented India's first budget on 18th February 1860. What is a government budget? Government budget is an annual statement showing item-wise estimates of receipts and expenditures during a fiscal year. Government at all levels, that is, central government or state government or local self-government, prepares its annual budget. The financial year is generally taken from 1st April to 31st March. The annual financial statement of the central government is titled as Union Budget. It sets forth receipts and expenditures of the government for 3 consecutive years. It gives details of the annual receipts and expenditures for the preceding year, revised estimates for the current year, and the budget estimates for the ensuing year. So budget is prepared in India 1st April, its duration is 1st April to 31st March of the next year. Objectives of government budget. Budgetary operations of the government have an important bearing on the functioning of an economy. The ideals of welfare state and economic planning have tremendously increased the magnitude of public spendings. Government collects huge sums of money through taxation, borrowings, and other measures. The manner of collection of those monetary funds and the pattern of their spending influences the economy in many ways. They influence savings and investment levels, distribution of savings and distribution of income and wealth, allocation of resources, and the consumption behavior of the people. Thus, the government budget becomes an important instrument to implement the policies of the government. Budgetary policy is the government program of making changes in the pattern and level of its expenditure, taxation, borrowing in order to achieve certain objectives. What are these objectives? The first objective is the reallocation of resources, or we can say proper allocation of resources. Through the budgetary policy, government aims to reallocate resources in accordance with the economic and social priorities of the country. What is economic? Economic is the profit maximization, and social priority is public welfare. Government can influence allocation of resources through tax concession or subsidies. To encourage investment, government can give tax concession and subsidies to the producers. For example, government discourage the production of harmful consumption of goods like liquor, cigarettes, etc. through heavy taxes and encourages the use of some essential products or some products which need to be encouraged, such as khadi products, by providing subsidies. Number two, directly producing goods and services. If private sector does not take interest, government can directly undertake the production. In this way, the government can reallocate the resources. So government tries to reallocate resources in accordance with the economic and social priorities of the country through its budgetary policy. The next is reducing inequalities in income and wealth. Economic inequality is an inherent part of every economic system. Government aims to reduce such inequalities of income and wealth through its budgetary policy. How? Government aims to influence distribution of income by imposing taxes on rich and spending more on the welfare of the poor. So the money collected from the rich in the form of tax, government spends that money for the welfare of the people. It will reduce income of the rich and raise standard of living of the poor, thus reducing inequalities in the distribution of income. Next is economic stability. Third objectives of government budget. Economic stability is one of the important objectives of budgetary policy of the government. The policy of surplus or deficit budgeting is adopted as and when the government is required to control inflation or deflation. During the period of depression, that is deflation, during the period of depression, the government adopts the policy of deficit budgeting. That means the government expenditures are more and government receipts are less. Under this policy, the government needs to increase its spendings and cut down its taxation. These fiscal measures help boosting aggregate demand in the economy, and thus the deflationary gap reduces. On the other hand, during the period of inflation, the government adopts the policy of surplus budgeting. Under this policy, the government is required to increase taxation and cut down its spending with a view to controlling the excessive rise in aggregate demand. Thus, government tries to control business fluctuations and maintain stability through budgetary techniques. So, economic stability means it controls the fluctuation in the price level. That is, it controls or manages inflation and deflation. Next is management of public enterprises. There are a large number of public sector industries where the government has the natural monopolies which are established and managed for social welfare of the public. Budget is prepared with the objective of making various provisions for managing such enterprises and providing them financial help. Where economies of scale over a large range of output can be received or one single firm can produce at lower average cost, it is termed as a natural monopoly. So what is natural monopoly? When economies of scale over a large range of output can be received or one single firm can produce at a lower average cost, it is termed as a natural monopoly. Next is economic growth. Economic growth has been the main objective of all the societies at all times. Budgetary policy has been and is being used to achieve this goal. The growth rate of a country depends on the rate of savings and investment. Therefore, the roles that are assigned to budgetary policy in this regard are to create conditions for increase in savings and investment. Next is reducing regional disparities. The government budget aims to reduce regional disparities through its taxation and expenditure policy for encouraging setting up of production units in economically background regions, and thus it tries to minimize the gap between developed and less developed areas or regions. One more point we can explain, that is generation of employment is the important objective of government budget. In this regard, government needs to promote labor absorbing technology, public works program like construction of roads, dams, canals and bridges, and to undertake employment specific projects. And thereby it tries to increase or create employment opportunities for the people of the economy. Components of government budget. A government budget has two parts. One is receipts, another one is expenditure. And that is revenue budget and capital budget. What is revenue budget? Revenue budget is the estimated money receipts from all sources of the government. This revenue budget, components of revenue budgets are revenue receipts and capital receipts. Revenue receipts which neither create a liability nor lead to reduction in assets of the government. Revenue receipts are further classified into tax revenue and non-tax revenue. What is a tax? A tax is a compulsory payment to government without expectation of direct benefits to the taxpayer. For example, taxes on income, wealth, property, manufacturing, sales, imports, exports, etc. Non-tax revenue receipts of the government from the sources other than taxes are called non-tax revenue receipts. For example, rent received by the government, interest received by the government, profit received by the government, dividend received by the government, fees, fines, special assessment, and estate. These are the non-tax revenue receipts. Tax is of two types: direct tax, indirect tax. What is direct tax? If the liability to pay a tax and its burden falls on the same person, it is termed as direct tax. Burden of a direct tax cannot be shifted to the other person. Direct taxes generally levied on the property or income of persons. Indirect tax, if the liability to pay a tax and its burden can be on different person, it is called indirect tax. Therefore, the burden of indirect tax can be shifted on other person. Indirect taxes affect the income and property of persons through their consumption expenditure, such as sales tax, excise duties, now GST. These affect the consumption expenditure. Higher the tax, then higher will be the consumption expenditure, and lower will be the saving. Further, we can classify the direct tax into three types of, that is progressive, regressive, and proportional. Progressive is what? The rate of tax increases with the increase in tax base. Regressive, the rate of tax decreases with the increase in tax base. And proportional, the rate of tax remains constant irrespective of the tax base. Now let us come to the capital receipts, another part of budget receipts. Capital receipts are those which either create any liability or reduce any assets of the government. For example, borrowings of the government, recovery of loans, other capital receipts. Now, in this case, capital receipts to such as borrowing. What happens in the borrowing? It creates liability of the government. So, one of these two property, creation of liability or reduction in asset, will happen in case of capital receipts. Recovery of loans. What happens? In this case, recovery of loan is a capital receipt because it reduces assets of the government. Other capital receipts, budget expenditure, another part of the budget. Budget expenditures are the projected expenditure from all heads of the government. Budget expenditure has two parts: revenue expenditure and capital expenditure. Capital expenditure. Revenue expenditures are those for which there is neither creation of asset nor cause any reduction in liability. For example, subsidies, expenditure on scholarships, etc. And capital expenditure are those for which there is either creation of asset or reduction in liability. So it either creates assets or reduce liability of the government. Construction of building. What happens in this case? Construction of school building is the capital expenditure of the government because it creates assets. Repayment of loan. Repayment of loan. It is capital expenditure because in this case there is reduction in liability of the government. Now let us come to the plan expenditure and non-plan expenditure. Plan expenditure are those expenditure incurred on the programs detailed in the current 5-year plan of the government. And non-plan expenditure are those expenditures of the government which are not detailed in the current 5-year plan. So, plan expenditure is spent on current development and investment outlays, whereas non-plan expenditure is spent on the routine functioning of the government. Plan expenditure arises only when the plans provide for such expenditure, but non-plan expenditure is a must for every economy and the government cannot escape from it. Developmental expenditure and non-development expenditure. Developmental expenditure refers to the expenditure which is directly related to economic and social development of the country. For example, expenditure on agriculture and industrial development, education, health, social welfare, scientific research, etc. These are the example of developmental expenditure because these are directly related to the economic and social development of the country. Non-development expenditure refers to expenditure which is incurred on the essential general services of the government and not directly related to economic and social development of the country. For example, expenditure on defense, administrative services, police, justice, etc. It does not directly contribute to economic development, but it indirectly helps the development of the economy. Such expenditure is essential from the administrative point of view. Now let us find out what the difference between developmental and non-developmental expenditure. Developmental expenditure directly contributes to development of the economy, whereas non-developmental expenditure does not contribute directly to the development, but it lubricates the wheels of economic development, means indirectly. Development expenditure is productive in nature as it adds to the flow of goods and services, whereas non-developmental expenditure is not concerned with the productivity of working class. One more point we need to discuss in this case is this tax. Why do we pay taxes? Or what is the significance of taxes, paying taxes? So let us know the significance of paying taxes. Taxes are the main source of raising money for the government. Taxes can be used to raise the prices of those goods whose consumption is harmful, such as alcohol, tobacco, etc. Taxation can help in reducing inequalities of income and wealth of a country. Taxes can be used to raise the prices of imported goods so that people buy domestically produced goods and services. Taxes, mainly direct taxes, can be used to ensure price stability. They reduce the disposable income with the people and hence reduce the level of aggregate demand. Lowering the taxes may help to boost employment opportunities. Next, tax revenue can be used in preparing the development of agriculture and industry. The government can also use this revenue to build up necessary infrastructure like transport, communication, power, irrigation, or infrastructural development work. So, this is the significance of tax. So, we come to know how to identify the revenue receipts, capital receipts, revenue expenditure, capital expenditure. Just we need to know the definition. Just let us try to understand how to define it. Revenue and capital, expenditure and receipts. In general, when we spend, we receive something that increases our assets or creates liability. If we borrow from someone, we'll receive money, but it will create liability. If we sell our asset, we'll receive money, but asset will reduce. Where these two things, either of these two will happen, will be known as capital expenditure. And when these two things are not happening, such expenditure will be termed as revenue expenditure. In case of receipts, when there is reduction in assets or creation of liability, this is capital receipts. And when these things will not happen, that is revenue receipts. In case of expenditure, what will happen when we spend something, we receive asset that leads to increase in asset or it creates liability. When we suppose we borrow, we take loan, then liability is created. So that receipt results in creation of liability. Or when we sell our asset, suppose government sold one office building, that results in receipt of the government, but against it the government asset reduces. So normally in case of receipts we find there is either creation of liability or reduction in assets. So when these either of these two things happening, then it is called capital receipts, and when neither of these two things are there, then it is called revenue receipts. But in this way we can define revenue and capital concepts. That's all for today. Thank you.